I'm Keith McCullough, and welcome back to another Real Conversations. It's my pleasure to have Jesse Felder from the Felder Report. You might know him from that spot, or you'll know him better after we get through this discussion. He's very active, obviously, on Twitter with an opinion, which we quite like, having people that have opinions during times like this. Jesse, thanks for making the time.
Thanks for having me, Keith.
Yeah, you're in Bend, Oregon. I'm in Stamford, Connecticut. In the world, if we thought it was weird last week, if we would have had this discussion, I most certainly think you'd agree that it changed over the weekend. How do you think that this all, even if you took a crack at that first, how do you think it's come all together? Do you think there's any irony away from the most, the obviousness of the situation? I think is one thing, but is there any irony in terms of the economic realities and maybe the anger that people have out there?
Yeah, I think it's obviously there is a, great upset, and for good reason, as to, what's gone on, socially, in terms of, black people being treated by the police, and it's absolutely understandable. But I think there's also a deeper thing going on here. And it's funny because Warren Buffett kind of accidentally predicted this 20 years ago when he talked about corporate profits as a percent of GDP. And, he said that you've never had histories, periods in history where you've had these really high profit margins at the expense of labor share. Because that's basically how it works. Capital profits to the extent labor doesn't, and vice versa. And, he said that there would be political problems if something like that were to persist. And, we've seen corporate profits for the last 20 years just soar to record highs, and labor share soar and sustain at record lows. And so I think these are exactly the political problems that he talked about 20 years ago. This was an article he wrote for Fortune in late 1999, kind of at the peak of the dot-com mania, to talk about why stock prices were going to probably disappoint investors over the coming decades. And he was right about that. But he was wrong in the sense that he thought corporate profits were going to revert to a mean, sort of a mean, and we haven't seen that. And so we're seeing the political problems now arise from corporations, I guess, earning much more than they historically have been able to, and labor taking a much smaller share.
Yeah, and people now, as soon as the shit hits the fan, losing their job, and we have 40 going on 50 million people at this point. It's sad. It's unfortunate. So I can't disassociate that economic reality, someone losing their job, with something instigating that kind of a reaction, because this happened very quickly, and it's broad based. As we were talking offline before we went live here, you could see it in Portland, in as much as I could see it in New York City. So it's everywhere, and I think that's something that people can't get away from, and maybe they're going to start to understand after they watch their stock market have another update, of course, on that, what it might mean. Slide 128, guys, is a chart that Jesse also had in the Felder Report that really shows that, and isn't that amazing? Like, the betting on mean reversion's been a good one, right, Jesse? If you go back historically and you go back far enough, eventually the black line in this chart, I don't know if you could see it, but it's a chart you're familiar with. It's a chart I've talked for a long time about with clients, and a lot of our credit clients in particular are like, well, that black line, there are a lot of reasons why it's different this time, and it's not going to go to 6%. Never mind 6% now. It's not going to go back to where it was in the 1980s or the 1970s, or 100% of the time that it goes when you have an economic contraction. So, what is it? Like, is the Fed going to be able to stop that?
I think there are a few different dynamics, and one of them, to come back to these political problems, is we've seen the antitrust framework just be completely loosened to almost a shadow of what it was 100 years ago, 80 years ago. And so, we're allowing companies to just buy up all their competitors, create oligopolies, duopolies, monopolies in, industries, every single industry you can think of. So that gives them much greater, power in negotiating with labor. But, demographics and globalization were a huge part of this too. When we could ship jobs overseas, labor lost huge bargaining power too. But I think, the reason I wrote the post was, these two dynamics I've just mentioned have been kind of, talked about ad nauseum in the last 5 years. They're important, but I really do think we need to look at the Fed's role in all of this, in that, the Fed is charged with, maximizing employment. They really don't have any ability to try and do that except through the capital markets. And so the fact that they've, taken it upon themselves to try and boost asset prices, in order to try and boost the economy, boost employment, is kind of counterproductive, right? When you're trying to boost labor at the expense of capital, you can't do it through the capital markets. So, I think that it's incredibly disingenuous for somebody like Jay Powell to come out over the weekend or late last week and say the Fed plays absolutely no role in wealth inequality, when for the last 10 years they've been talking about trying to explicitly create wealth effects. So I think it's really important to look at Fed policy here too, and the role that it's played.
Yeah, that I actually, it echoes in my office because I'm pretty much one of the only people in here. But when Powell said that, he was asked the question, does Fed policy create perpetuate inequality? And his answer wasn't like, well, no, not really. He said, absolutely not. That's what he said. Absolutely not, Jesse. I mean, this is this is like almost. Remember, Bernanke would say, when the dollar was at a 40-year low and commodities were at an all-time high in 2011, when he's inverting the curve, explicitly trying to create inflation expectations. When asked about inflation, first of all, he'd never mentioned the dollar, and when asked about inflation, he's like, absolutely not.
Yeah, it's incredibly disingenuous, and I attribute it to this quote from I can't remember his name, famous behavioral economist. Who basically has written a fair amount about this, where he talks about, people in positions of authority understand very well that if you want people to believe something, whether, it's a flat out lie such as this. I mean, I think that's a flat out lie that, Powell claiming to not exacerbate wealth inequality. But you just repeat that untruth over and over again until people start believing it. And people in power, the media and people in power understand this very well. And so that, they think as long as we just keep our story straight, people will eventually believe us.
Well,
it's a shame.
That, by the way, it was a great quote by one of the great minds in economics, because of course he's using humans. He's using a behavioral overlay. That was Danny Kahneman. And you used it, and I actually underlined it in doing a little homework, of course, before we had this discussion. I'll just read it. This is a great quote, like relatively speaking to what anybody could say, more simply. A reliable way to make people believe in falsehoods is frequent repetition, because familiarity is not easily distinguished from the truth. Now, I think I know a president, or I don't know him personally, that understands, the repeating, and once you hit a point and he sees the nods, that's why he struggles. Trump struggles if he doesn't speak in front of an audience, because he doesn't get the feedback, and that's something that it goes all the way up to the top. I mean, he was back going all caps on the stock market last week. What do you think about that?
Well, some people have done some great work in this regard. I think Ben Hunt has written about this a fair amount, how, the stock market is becoming a political utility to a great extent, where, Trump looks at it, the stock market, as his scorecard in office. And, he understands his election chances are directly related to the stock market. And, the Fed, too, also understands that, if stock prices fall, that creates a vicious cycle where people you could get reverse wealth effects, right? People start feeling less wealthy. They start, curtailing their spending. So I think everyone now in power is targeting the stock market as a way to try and prop up the economy. And it's really backwards, but it is what it is.
But it gets to the point, too, where people get really pissed off. I mean, they may not be able to articulate, why the Fed bought 900,000 shares of the junk bond ETF, but they know. They're getting screwed. If everyone's about to get taken care of, and they're really not getting taken care of, I mean, this is part of this that I just can't shake here. Do you think that Trump will have the arrogance to talk about stocks being up in the face of what happened this weekend as being a good thing?
Gosh, I think he's probably talking to his base when he's talking about the stock market. And, politics has become so polarized that I don't know if he even worries too much about the people who are unhappy with what he's doing. But I do think, yes, we are reaching a point very quickly where this, the wealth inequality and, these kinds of things, and it's becoming exacerbated through the pandemic. Foreign Policy magazine had an interesting article, I think, over the weekend, where they called it, the disparity between what's going on in the economy and, people losing their jobs and 40% unemployment for people making less than 40 grand, and then stock prices, the NASDAQ, up for the year. It's grotesque. I mean, to quote with, the magazine. And so I think people from all walks are starting to realize, wait a second, once again, Wall Street's getting bailed out while we, the average person, the regular working man, is screwed. And that is going to, these political problems are just going to keep getting worse and worse so long as that trend continues.
Yeah, that I was having a discussion with one of my neighbors. Of course, now we all talk to our neighbors because we're in the neighborhood. But I'm having a typical conversation. My dog's in his yard or his dog's in mine. And we're not talking about who's got great performance or anything. This guy's a hedge fund guy. And he actually told me yesterday, he said, we've actually rallied all the way back. We're kind of break even to where we were at. He's like, I can't believe it's crazy. He goes, I'm going to get paid this year. And he's talking about how a golf club that he's joining for all the summer memberships that are on sale. And then he looked at me and he's drinking a Bud Light and he basically goes, but I'm not going to tell anyone that. That's embarrassing.
Yeah. Well, that was, so there's so many parallels. I think it was really interesting that, Buffett during his, the annual meeting, virtual meeting that he did a couple of weeks ago was talking about that period after the 29 crash. And he kind of focused on that. Robert Shiller wrote an interesting piece, I think, for the New York Times over the weekend where he's talking about, too, that these are the types of narratives that created a Great Depression that we saw kind of after the 29 crash. And, this trend from conspicuous consumerism to I don't really feel good about that anymore. That has huge effects on the economy, and that was one of the driving factors of the Great Depression. That's why jeans came into fashion. People weren't wearing suit and tie to work anymore. A lot more people started wearing jeans because they wanted to sympathize with the people that were really suffering. And
Right.
and so I think if we see something like that again, those types of narratives take hold. It could make for a really long, painful economic environment.
Yeah, in your notes too, like Jesse wrote, denying risk doesn't make them disappear. I mean, isn't that the reality of the cycle itself? And that's really wanted to bring this full circle because you do plenty of work on that. I always say it's the cycle stupid. I can go back to my inbox though, and I get stupid right back at me, like institutional investors, the fine folks that you used to work with on this side of the street. I mean, it's like they'll just say, but it's the Fed. I can't fight the Fed. It's the liquidity. So what do you say back to that on you can't fight the Fed?
Well, where that comes from is, I think, well, it comes from, QE, and we saw the buy the dip kind of, videos on YouTube and things. This meme has been around for a long time. But I think, to me, it's that Stan Druckenmiller 4 or 5 years ago talked about it in his address at the Lost Tree Golf Club or something like that. Real famous speech that he gave, 4 or 5 years ago, where he talked about, earnings don't move the markets, liquidity that moves the market. So pay attention to central banks. And so I think everybody's taking this to heart that, like the Fed is, running the money printer, you got to buy stocks. But a couple of weeks ago, Stan came out to, I think, clear that up, that this misconception that it's not just central bank liquidity. You have to pay attention to net liquidity. And how he explains it is it's the amount of money being printed by the Fed less the amount of treasury issuance that's soaking up that liquidity. And so if you have very little treasury issuance, relatively speaking, and a lot of, Fed money printing like we saw in March and April, then it's a recipe for higher stock prices, higher prices of all risk assets. And that's what we've seen. But he was making the point that now, the Fed is kind of tapering its money printing already, and we're starting to see huge treasury issuance come in to fund all of this, fiscal stimulus that they're putting in place and lost revenue versus, falling taxes. And so I think, it's very important to pay attention that, this net liquidity environment is rapidly changing from something that was a positive tailwind to risk assets to something that can be a real significant headwind or net negative liquidity over the, heading into the fall. Those are Stan's words, not mine. And so I think it's really interesting to hear from the guy who kind of pay attention, who's done this better than, all of us and pays attention to this, much more closely than anybody else. Really the liquidity master, is saying the exact opposite of what individual investors' mantra is right now in the markets.
Yeah, and on the other side of that, of course, you have so some of the older guys have come back in. Like you got Paul Tudor Jones writing again. You have obviously Druckenmiller writing. You had a lot of them writing the wrong thing coming into it, I might add. So, we did see, and to those that love the Fed, like it's like their second coming of Christ. I mean, by the way, and I'm a Roman Catholic, I'm not says nothing against Christ, but they clearly think that no matter what is the answer, when the reality is you only get the liquidity after the shit hits the fan. So to say that you have the Fed all the time is just inaccurate. Now, just to unpack that on Fed liquidity in terms of the net negative versus net positive, I think what you said was that Stan's argument is by June, July, you go instead of net positive liquidity to net negative liquidity, and that's like now.
Yeah, absolutely right. I mean, he was saying in May, you basically go flat and it starts becoming negative right about now. And, his conclusion was this is the worst risk reward setup he's seen in his career. So, I mean, he's not mincing any words there.
Well, I mean, and he also, he's not afraid to admit it, and neither am I. I mean, like, every single mistake that he's ever made, he's actually got the humility to go back and rewind and learn from it. But he was long the NASDAQ, same thing, during the last bubble that we had. And have you written about this? One of the best charts I like, or at least one of the best charts that I've seen from you, are the one that has the everything bubble in it. Stan was long stocks during the NASDAQ bubble, and he crushed it, and then he got crushed, and then he learned from it. How many people are long the everything bubble that have never been crushed?
Yeah, well, just to be honest, I mean, this is the craziest thing I've ever seen in the stock market in my career. And I was trading, I was head trader at a hedge fund at the peak of the dot-com mania, and I saw some crazy stuff back then. But people who were giving up their jobs to day trade back then were buying into this gold rush. The internet was a new thing, and this was really exciting, and there were some fundamental reasons why to be very optimistic. And so even though prices were out of line with reality, there were reasons, there were trends that kind of could back up at least people's optimism. Today you have kind of an unprecedented influx of novice investors coming into the market who couldn't be more excited about buying call options. We've seen the volume in call options is bigger than anything we've ever seen before in history. At the same time, we have the worst quarter of GDP in the country's history. The fundamentals for these companies are rapidly deteriorating. So, I mean, the dichotomy there between investor euphoria and the rapidly deteriorating fundamentals is the greatest disparity I've seen in my career.
Yeah, well, almost anybody's, if you have any respect for cash flow as having an underlying an underlying reality that is going to come home to roost. Guys, if you could go to slide 107, just I want to get Jesse's reaction to my. It's not the same bubble chart, but again, it's showing you. So if you go back to, I guess it does have the bubble chart from, and again, we're using, you mentioned Schiller, my old professor's CAPE ratio, but again, you go back to that peak, that was like 35 times earnings for the S&P 500, but on a CAPE basis, it was sufficiently the highest of all time. If you take that out, Jesse, and you just look at that chart and you think about mean reversion from cyclical peaks in earnings, it is also the end of the 1920s, where you get inequality gaps. So again, you get an extension of the price they're going to pay for a deteriorating cash flow stream that used to be an accelerating cash flow stream. How do you think about it in terms of that?
Yeah, I think the CAPE ratio is one of those indicators that's vastly better than a simple price to earnings measure. But I think the one thing that makes me want to lean away from it is, I guess, all the thing the same thing that made bulls want to kind of disregard it during the upturn, is they said, back in 2014, 15, 16, stocks were getting really expensive on the CAPE measure, and they said, well, that's because it includes 2009, which was a huge earnings bust. And my response to that was always well, that was Schiller's purpose in creating this. It was supposed to be the cyclically adjusted PE that it would include recessionary earnings. You would see full cycle earnings, not just upcycle or just peak of the cycle earnings.
Right.
And right now, we're in 2020. We've kicked out the 2009 earnings decline. So we only, the CAPE measure only shows a period of earnings growth that doesn't even include a cycle, a down cycle in it. So I would say that it's probably even, equities are more overvalued than the CAPE measure would imply right now.
Yeah, and if you look at them on a debt-adjusted basis, they're even more expensive. So if you guys go to slide 102, so that just shows you the EV to EBITDA multiple. You're in the 100th percentile on a 20-year look back. And that's the last time, people are like, well, if you look at earnings or cash flows, with the new normal of cost of capital, then it's good. I mean, we just blew through that door, and now we have the most, corporate issuance ever. Now that the Fed turned it back on, so we're going to be even more levered on a lower earnings number. That's interesting.
Yeah, and that's the other thing that Stan talked about too, and kind of goes into this, the craziness that's going on in stocks right now. Is there's a good chance we just pricked the corporate debt bubble, that we had record high corporate leverage. That was a function of a product of the Fed lowering rates to zero and encouraging a bunch of debt buildup on corporate balance sheets. But now, we're starting to see defaults rising, bankruptcies on the consumer and the corporate level. So there's a good chance the cycle's already turned. And if we've just pricked this corporate debt bubble, then there's almost nothing the Fed can do to prevent a very, very deep recession.
Well, people, what they tell me, and by the way, while Jesse and I are well aware that while you might be sitting there and you're saying, oh wow, these guys are interesting, but then you take the other corner of your eye, you look at your screen and stocks are up, you're like, oh, but it doesn't matter. Eventually it matters for everyone when the least amount of people are positioned for it. So just to be clear, Jesse and I, it's not our first rodeo. It might be yours, if you think that. But you're going to learn at some point, and it's going to be painful. But on that point on corporates, okay. So I get told this is what comes back to me, right, Jesse? My inbox is on the other side of Wall Street, the buy side. Pension funds, mutual funds, hedge funds. You pick whatever fund, and they'll come back to me and they'll say, but they got more to do there. So what they're going to do with high yield spreads is that they're going to mark them to model. I can't even say it any other way. That's obviously when I say that back, they're like, well, that's not what we're saying. I mean, what are you saying then? We're gonna make high yield trade like 500 over to 600 over in perpetuity, no matter what the cycle is. Major CIOs of some of the biggest places that you obviously know will say that back to me. Like, I don't even know what to say back other than, why the fuck do we do this? Like, why do you need any analysis if that's what's going to happen?
Well, then this is what Mohammed Al-Arian has been kind of worried about, is that then you just create a zombie market. And, productivity is going to go in the toilet because you don't have any of these companies that should go bankruptcy. You're going to prop up all of these unprofitable businesses, and it's going to end up ruining the economy, ruining the markets, because we're not going to have any efficient allocation of capital. So, these things, I think, Chris Cole has done a great job of talking about how these things can paper over problems in the short run, but you can never get rid of these problems or get rid of the volatility that they'll create. You can only push it into the future. And so, that's exactly what they did in March and April, was all this money printing. They prevented, a bigger meltdown, but they only postponed it. They didn't really prevent it. They only postponed it. So it's coming.
And that part of it, I mean, it's very consistent actually of the beginning of a bear market, is that you get one mother of a rally. In this case, you have the mother of all central planning, actions to perpetuate that at even a faster pace, I suppose. But you can't eliminate the cycle. You can't eliminate gravity. That's all I keep saying over and over and again. And eventually, I'm either going to be dead wrong or I'm going to be right again. And I don't know what else to say other than just that. If you're going to tell me you're going to have 40 to 50 million people unemployed, and now you're smashing the windows of small businesses too, and it's not just corporates that were levered out the wazoo on the public side. It's like all these small businesses, they got used to running with a lot of leverage too.
Well, and I think too, to come back to that counter argument, which is the Fed's going to literally just buy as many corporates and junk bonds and treasury bonds that they need to prop this whole thing up. The dollar's going to go to hell in a handbasket in a heartbeat, and that's going to have inflationary problems of its own that are going to prevent the Fed. My friend Bill Fleckenstein's talked about this. At some point, the bond market's going to take the printing press away from the Federal Reserve. They can, if they make the choice that we're going to try and pin, we're going to yield curve control no matter how much new debt issuance there is from the Treasury, and we're going to, pin corporates to spreads. I mean, they're going to have to print an unbelievable amount of money. When we're talking, tens of trillions of dollars maybe in order to get this done, and the dollar is going to tank as a result, and we're going to get inflation. We're going to get major problems coming out of it. So I think we're rapidly approaching that point where the Fed is going to reach the limits of its powers. But that's just my opinion.
Well, I mean, it's also, but it can be the opinion of people that have been writing bearish things, since birth, or you can have, whatever. You can jump on zero hedge and scare the shit out of people every day. In an upcycle, when earnings, back to your point on that Shiller ratio, like anytime somebody told me, stocks are too expensive in 2017, I'm like, well, they should get more expensive because the rate of change of profit growth is going to accelerate procyclically with tax reform. It accelerated all the way up until the Russell peaked in Q3 of 2018, as you know, and that was it. Then we started to see the issues, right? The cycle started to roll over, did not slow into a recession, but you started to see the weak companies, triple C companies in the credit space, shit companies in the Russell that don't have pre-tax income anyway. So this thing had been in motion. So now you have like the great panic saying, well, this can't happen because we said it can't, and then you just have time and space. So again, and there's a bit of a rant, as I'll do, but I mean, what I love about some of your comments here is that you're drawing on the, I guess, the wisdom of the crowd as opposed to the monkeys chasing the charts, which is, Chris Cole. So for example, he looks at markets through the lens of, like I do, I don't look at the price, I look at the volatility of the price. And I look at that, and if you look at slide 94 and 96 back to back, Chris would probably say the same thing. I don't know if you agree with this or not, Jesse, but I see, if you go back to 2000 to 2002, or I see what I think is the beginning of the same thing, when you have a lot of leverage in the system, there's a long workout period for both equity vol and high yield vol. So high yield spreads rise, the Fed tries to do something, but again, they are chronically wide and volatility is chronically high. Like today, the stock market's up, but the VIX is up. It's not breaking down through 20 or anything like that. So to me, this whole thing, when you say you're just delaying it, like my number one signal on saying I disagree with you, Jesse, on that, is that high yield spreads and vol, as a similar set as we'd say in fractal math, they're breaking down and we're wrong. That's where I would just throw in the towel, not just sit here and chew on daily trades that I'm rolling through. What do you think about that?
Well, I think, there's a lot of different things. I mean, that your volatility chart was great. The spreads charts, a lot of these things are interrelated. And you look at a longer term chart, the yield curve usually leads volatility and leads corporate spreads. And so right now you look at things like the yield curve, it leads by 2 years. So this thing would suggest that over the next 2 or 3 years, we just entered the very beginning of a high volatility environment, not the tail end of it, as a lot of bulls would have to believe if they think now is this generational buying opportunity, like a lot of these millennial call option buyers are literally quoting to Bloomberg. And so I do think that there's tons of signals that show this is the very beginning of a new credit cycle, very beginning of a high volatility environment. And just to kind of come back to the way the market's responding to all this, metaphor that's always stuck with me is go back to Ben Graham. Market in the short run is a voting machine. In the long run, it's a weighing machine. Right now, people are voting, with their trading accounts, with their Robinhood accounts, and they're voting that the stock market should be higher. But longer term, and that's I think before the end of the year, stock prices are going to have to reflect the rapidly deteriorating fundamentals. And so, the market's going to become a weighing machine at some point in the near future.
Well, the weighing machine, by the way, is also like earnings season. It's all like this guy that used to work, like when you were at maybe when you were at Bear Stearns, I was at the place that was eventually became Pequot Capital. There's a guy by the name. Do you know who Dan Benton is?
No.
You ran the biggest tech book at what was Dawson Sandberg, and then Pequot, he's former Goldman alum, pretty famous guy back in the day. And he'd always say, and I remember he'd have these calls, and the rest, and I was a fairly young analyst at that point, he'd say there's earnings season and then there's macro season. So we're in macro season where the tape can be bullied, futures have been, I want to ask you about that. But earnings do matter. I mean, if you look at why the stock market, had part 2 of that sell-off in April, it's because the financials showed negative 35% earnings growth. Healthcare was up 9% earnings growth, so there was a divergence that started. But we're talking about like the rest of the story, which is the rest of the earnings story. I mean, I have had people actually tell me that earnings don't matter anymore.
Well, and that is the mantra. I mean, and Twitter to me is a wonderful real-time sentiment model. I tweet tons of stuff. In the very opening of this interview, you said I express opinions on Twitter. I really don't. I mean, I do a lot through my blog and my writing, but on Twitter, I just try and put up what I see as a lot of the trends that are out there, the narratives that are building. But it's fascinating for me to see what are the reactions to this. And the reactions to almost everything I tweet right now are, it doesn't matter, just buy stonks. Stonks only go up. When the Fed's printing money, when the printer presses go burr, it's time to buy. Literally, that's the only thing in my feed right now. And so it's so clear to me that sentiment. I mean, people who are bearish have absolutely just thrown in the towel, said you can't be bearish when the Fed is printing money. And people who are bullish think they're they say don't confuse brains with a bull market. And I think they're people that literally have bought into this, thinking this is a 2-month-old bull market, and they've been right for 2 months, and now they think they're brilliant. And that anything about earnings, like you said, or about the economy are just a waste of everyone's time to even think about. And so yeah, it's absolutely euphoric sentiment out there.
It
which
is.
To me, it's a contrarian signal.
It is. I've never, like, this is my third one, because again, big market crashes in 01, 02, and then surviving and starting Hedgeye in 08. But this one, that I have a contra stream that I built on Twitter that is a beauty, right? Like, I used to block them, but now I need them. Like, I can't. I can't believe what they say. Like, it's like a piano. The thing, and I can't play the piano, but they play it beautifully. I mean, it's like.
Oh, it's great. It is beautiful, and I use it for that. I mean, literally in February, mid-February, I tweeted, and insider buying and selling is something I monitor very closely every single day. And I started tweeting in mid-February, I'm seeing insider selling just blow out, just like literally through the roof. And I had a couple, well-respected people on Twitter say, this is just fear-mongering. This insider, people sell for all different kinds of reasons. I'm like, hey, look, you can look at it quantitatively. These guys are blowing out their ownership stakes in these companies, and it's going to mean something eventually. So those types of signals to me are invaluable. Yeah, I've never blocked anybody. I probably shouldn't say that, because now people know they control me endlessly and won't get blocked. But I like to use it as a sentiment signal, so that's why I haven't blocked anybody.
Yeah, it's that's a whole new world, but I do think that it's a great way to, and we're working on ways to quantifiably measure that, that sentiment. But wow, it's fascinating to watch. But it just means that you have a lot of participation that ordinarily wouldn't be there. The other thing that you see, in addition to what you said, which we saw a wave of insider selling ahead of having report corporate reality, is that flows. Flows have been out of equities and into high yield and junk and everything else because people just flowed, like Reader says at BlackRock, well, just buy what the Fed's buying. Well, I'm not fighting the Fed with that. I buy treasuries pretty much every day that they're at the low end of my risk range, and I was alongside the Fed with that. But stocks, they're not buying every stock. Insiders certainly are. I don't see insiders buying stocks. And then you see the people at home are like, wow, I should sell into this. I mean, and then you get the futures that are moving. And that's where I get a whole other round of questions. How do you answer that question on the PPT, by the way? You look at the charts of where the market's trading in the pre versus where it's trading during the actual trading day where cash settles. Like, how do you answer that?
Yeah, we could speculate endlessly about what's driving it. My best guess, and I really don't know, but my best guess is that the markets, have been really taken over in the last 10 years by algorithmic strategies. And those strategies, a lot of the time, are just driven by essentially a kind of a short vol framework or volatility targeting type of framework. So when vol is falling, they have to start adding. You have, adding to equity exposure. And so I think there's just this, it feels like a relentless bid. And I think that's, we saw risk parity as one of these volatility targeting strategies I'm talking about, but insurance companies use volatility targeting. And in all of these things, basically the way I look at it is they exacerbate moves up and down. So when it feels like the market's just going endlessly up and there's this endless bid, I think a lot of that is just risk on by a lot of these algorithmic strategies driven by kind of a short vol framework. And it was the same reason why we had the crash in March was all of those strategies were super long. Volatility started rising. You have short vol guys have to start covering. That creates a vicious cycle. And then you have volatility targeting and risk parity. They all have to start deleveraging, and it results in a crash. And I think right now with the rally, that we've seen over the last couple of months, a lot of that is just these guys having to put exposure back on because volatility is falling. The market is trending higher, so trend followers are getting back on, and it's not driven by any type of strategy that looks at fundamentals at all. It's all just systematic, and so that's my best guess, I guess.
It's an educated guess. I mean, I worked at Magnetar, for example, which is spun out of not spun out of, but they left Citadel. So when I think about like how the machine actually works and how even fundamental factor-based strategies work, and how money actually flows, my eyes were like wide open in 06 while I was there. And then you watch it, you trade it, you feel it. You actually have to feel something when you're observing. Wow, this is a different game than when I came into this game. It's really manifested. So then when I read The Man Who Solved All Markets, then it all made sense. It's like he doesn't care why. They don't have a narrative. Like you said, if it's vol, it's vol. But now I look at that and I say to because I always look at markets in terms of, and I want to see what you think about this. I mean, I look at markets in terms of 3 regimes of volatility. Okay, investable vol, like where you said where a 3-ring circus monkey can make money on the long side, unreformed brokers are not. So that's VIX, call it between 9 and 15. Once VIX starts to go into the wrong bucket or the chop bucket, call it into the high teens, into the high 20s, that's where markets are trying to signal that they may or may not be undergoing an economic phase transition. Great trading market. And then when you're beyond 30, or called high 20s in the VIX, to 50, 60, 80, that's the fuck bucket. Like you're out. Like we've had vol actually trade in the tradable bucket for a good month here. And anytime the VIX gets above 30, you see all of a sudden all the strong-handed narratives. My contra stream on Twitter falls down like on its face, goes mute on its own. You don't have to block it; they just shut down, right? so that's to me what I'm seeing. Like you have to break you have to get us out of that vol bucket. Which again, you go back to that slide 94, guys. There's no investor that you know or I do, Jesse, that's made money as a bull when vol stays pinned in that regime, ever. Like you have a fit and start in December of 2018, but it didn't stay there. That's called like what Mandelbrot would call just a cluster of vol, or a cluster, bucket. I've already used the word. I always promise myself only use the F word like more than twice as bad. But that's it. Like if they can't, that's what I look at. I might be totally crazy, but the VIX today is still at 28. Now, how many more bites at the apple can the machine take? And what you find is that the shitty quants who chase the smart quants, they all mimic each other to the point where even Simons would say, well, then your best bet is to get out down 10% so that you're not out at down 40% in that strategy.
Yeah, and I think that's a great way to actually look at the markets, because that's the way that the algos look at the markets is, so long as VIX is low, then we're long. And, once VIX starts rising, we have to start delevering. And that to me helps explain why we have these persistently low vol environments where, the market just keeps chugging higher and vol stays low. It's kind of a virtuous cycle, where vol's low, so they buy. So vol gets lower, so they buy more, and then. But at some point that reverses, and I think we really started seeing this play out in that early 2018, the VXO or the XIV, debacle, where the thing literally went to zero overnight. Where we started realizing, wow, there's this whole short vol framework out there that's much bigger than just explicitly short vol. All of these guys are short vol that are using volatility targeting and these types of things. They're using it to be, take a much more equity exposure and risk than they otherwise would, thinking that it's very much like portfolio insurance in that led to the 87 crash. Everybody thinks they can take way much more risk than they otherwise would because we're targeting vol. When vol starts rising, we're going to get out.
Right.
And so I think we saw this crash in early 18. We saw the thing in late 18, and then we just saw in March of this year. And this is going to continue, but this is this new high vol environment that I think we just entered in. It's going to last for several years. And you're absolutely right that the message should be to individual investors that this is not the time to just go buy and hold. This is not the time to just you're going to make money on the long side as a do nothing passive investor. This is the time where you need to be ultra careful.
Well, I mean, again, all people come back to is what the thing is up from its low. Like, give me another CNBC monkey that tells me, oh, look at the return since the day that we couldn't even breathe. And having warned none of the drawdown, of course, one of the most, well, was the most epic point-to-point drawdown in vol space ever. Like, again, because you compress a period of time, it was as fast as 1987 with more days. So you get that narrative, and these people are like, wow, if I buy Hertz at 50 cents, it can go to $1.
Yeah. Yeah. And, I just saw an article today that, the assets in the Jets ETF, basically it's the top 4 airlines, has gone from 33 million to almost $1 billion in the last couple of months. People thinking now's the time to buy airline stocks. And so, yeah, it's wild what's going on in the markets right now. People aren't thinking about vol. They're not thinking about it's just this, buy the dip mantra. And this is also, it comes back to this, this Fed thing, that if the Fed, I think Jay Powell knows that the moral hazard has jumped the shark. Everybody knows we can buy stocks now because Jay Powell is going to save us. And now the millennials, who've been actually absolutely crushed during the financial crisis, now they've been absolutely crushed, in terms of their jobs and things. Now they're saying, well, shoot, the only way out of this is for us to buy stocks. And I think Jay Powell now feels like absolutely backed into a corner. Like, okay, now if the millennials get crushed on their trading positions, right? I mean, the Fed's out of business, right? I mean, there's going to be such a backlash against the monetary authorities. It's going to be, it's going to make what we've seen over the last couple of weekends look like child's play.
Well, I've always thought that they're going to get blamed. I mean, this all started with Bernanke saying we have a new normal. In 2006, he became head of the Fed by saying we have a new normal. Us, glorious central planners can suppress market volatility, and again, effectively, I don't think he said eliminate the business cycle, but certainly tone it down. And then Janet Yellen came and said, see, well, Ben had to deal with this one thing that's a once-in-a-lifetime thing, and then boom, it happens again. It keeps happening at a faster rate, and more people losing a bigger amount of money all at the same time. So in the end, the Fed absolutely is going to hold the bag on responsibility. I don't know how they could think otherwise.
Well, the Fed to the economy is very much like these algos to the markets. I said the algos exacerbate the regular market cycle. The Fed is exacerbating the economic cycle, making the booms go bigger, and so the busts are bigger. And so, absolutely, I think, we're in this, strange environment where the Fed is doing what they're doing, and they're creating all kinds of crazy euphoria on the part of individual investors. And it's I know you guys do a lot of work with Neil Howe, and I think that fourth turning concept is really interesting. I do think we're headed for a change, a massive change, and it's going to, the Fed is going to have a target painted around it at some point, and probably in the next few years. If we do have another major economic crisis, and I think we're already in the midst of one, in the aftermath of that, the Fed is going to have to take some blame. They won't be able to avoid it.
Yeah, if we weren't in an economic crisis, you wouldn't have the Fed doing these ridiculous things. I mean, and that's the point. When we get the next round of things, Jesse, there's only one thing for them to do, and which is we've been discussing for 40 minutes, which is to buy stocks. And to me, like Fonzarelli 101 jumping at the shark, I don't think people understand the JNK or the HYG ETFs. They'll understand Apple.
Yeah, I already think that there's already a backlash to the Fed buying junk bonds, buying corporate bonds, because what does that do to help the economy? It only bails out investors. It does not, that's not new money going to those companies to help them through this time. It's just propping up investor portfolios,
right?
Which is that is just explicit, bailing out investors, bailing out Wall Street, bailing out hedge funds, rather than, it has literally no Main Street effect at all. And so stocks would be taking that to the nth degree. I think that they would be reluctant to do that. They probably will have to go that route, but they're going to be putting the nails in their own coffin at that point with the backlash.
Well, I mean, try this with your Twitter stream. It's a little experiment I tried on Friday. I said, who gave the Fed the list of the ETFs, the fixed income ETFs to buy? I just asked an open question. There were a varieties, like the varietal, I should say, of responses to that question. But there were actually, the people had a lot. There are people hitting the same answer quite a bit, and then there's different answers. But it's people are becoming more aware. That's the other side of the Twitter stream, don't forget, is that people like us are there.
Right. I should do that because, just to see the variety of responses. I'm going to go look at your tweet. I'm not going to I don't want to put myself in the middle of it. I'll just go look at yours.
All right, let's get, if you have questions for Jesse, already we got a whole bunch. And you're not getting it. These questions aren't getting any downvotes as far as I mean, they have some, but there's a majority. There's a 45 spread. Look at the spread of upvotes versus downvotes, Jesse. So this is number one. I haven't read it yet, so I'll just read it. I know this question can rub folks the wrong way, but considering the will and apparently disregard for legalities between the Fed and the administration to push the markets higher, what is going to stop them? I get it. Everything is out of whack and they don't care. Any thoughts on that?
Yeah, I think I mentioned it a little bit earlier that in order to the markets are going to start to roll over again, and I think that is going to be a frightening experience for these newbie investors. That if the Fed is printing trillions of dollars, expanded its balance sheet by 3-4 trillion in a couple of months' time, and it still can't hold the stock market up, that's going to be a frightening experience. And so I think that if stocks start rolling over, we're going to start seeing some real fear enter in the markets again, and probably more than the type of fear we saw even in March. But if the Fed does then decide, okay, we need to go much bigger, print even many more trillions of dollars, the risk there is that the dollar itself starts to decline in value, because it's being debased so rapidly. And you think about, okay, what happens when the dollar, is going to decline in value rapidly? Well, that's going to be very inflationary because we get a lot of goods from overseas. So price of all that stuff's going to go up. And it's the Fed kind of shooting itself in the foot, because if inflation starts really taking off and they're printing tons of money, how are they going to fight inflation? They can't raise interest rates because they can't. The federal government won't be able to afford to pay the interest on the increasing debt. They'll have to start reining in the money printing in order to try and prop up the dollar. Yeah. So so there are limits to this, and it will. I think it'll show up in the currency markets first.
Yeah, that is the bugaboo of all bugaboos. I mean, that'd be a polite word to use, and I don't even know what that word means, so let's just not use that word. But back to my neighbor with the dog and the Bud Light. He also said to me, he goes, "Hey, did you guys you see how much they're like gouging us at?" And I'm not going to name the butcher in Westport that he was talking about, and it was really just like a butcher within a supermarket. And he was like pissed off about how much ham and meats for his kids for sandwiches were costing. And then he looked at me and goes, how do the people that don't have a job pay for this stuff? And why aren't they really pissed off? That's just getting it started, right? So what you just said in my vernacular is called quad 3, stagflation. Deflation is when the multiple goes up because the P hasn't come down and people are in disbelief, but the E's falling. So actually the market gets more expensive. The stagflation, which confounded Buffett too for a part of the 1970s, as you know, is when you give the world inflation and the people quite literally have to eat the cost while the people that are along those things get to ride it. So that's what's going to make inequality as wide as it ever gets.
Absolutely, and I think that we're already seeing that. We're seeing core CPI is dropping like a stone. Yeah. But at the same time, you're seeing consumer inflation expectations ticking up. Right. And I think it's because of these things, because of meat and the prices of these things that you have to buy are all going up in this environment. So, and I think people underestimate how much inflation expectations actually create in the inflation dynamic. And so if consumers get in the mindset of, inflation is becoming a problem and start, I guess, behaving in an inflationary way, that they believe inflation's going up, that can only kind of be a self-fulfilling prophecy that, inflation will begin to rise because people start, and that's what we saw, people hoarding toilet paper, hoarding these types of things, and that created a lot of the price rises that we saw. So if that were to continue, that would be very problematic. And I agree. I think we're more, rather than another Great Depression, I think we're more likely headed towards a stagflation type of environment over the next several years.
Well, if the way devaluing and we had all that, that's all supply shock oriented inflation on things that you absolutely need, right? What we're talking about is dollar denominated inflation, or the part of the stag, which stagnates real consumption growth. And this is like, we have not seen a period like that in U.S. history. Again, there's a reason why the S&P 500 traded at 7 times earnings in the 1970s. Because again, the earnings were they just would not come back. The jobs wouldn't come back. And I think that's going to be the economic gravity of it all. Next question, and this question, I have an answer for this. It annoys me sometimes. But again, this is a question because on CNBC every day, that's all they'll talk about. What advice would you have to those of us who are still siding with economic reality and gravity and being actually short the S&P 500? Because consensus is short the S&P 500. If you guys show futures and options, this is Wall Street's hedge. It's not mine, but anyway.
Well, I mean, they also had, speculators in S&P futures were also hugely short in 2007, early 2008, and they were right.
Right.
And so, that's kind of how that works is, smart money says we need to start protecting ourselves. And so it's not always a contrarian indicator. But I would say for the average person, maybe the most important investing lesson that I've learned is when there's nothing to do, do nothing.
Right.
Jim Rogers talks about that in Market Wizards. Warren Buffett, I mean, why is he piling up so much cash right now? Why is he only a net seller during the first quarter? Is because there's nothing to do. Jesse Livermore. You go back and read Reminiscences of a Stock Operator. And he talks about you always feel like you need to be trading. But every one of his best trades were times when he knew he was going to be right before he even put the trade on, and that's kind of what Jim Rogers talks about too. You wait for opportunities to where it's like $5 laying on the floor. You just got to go pick it up. It's that simple. So if you just, as an investor, don't try and do all the hard trades and take every trade there is. Just wait for the ones that are right in the absolute wheelhouse, and you're going to make money on it. Then a lot of the times you're going to be doing nothing. And I think for the average investor right now, short selling is not a great idea. Charlie Munger said we don't like trading agony for profits. Short selling can be very agonizing.
Yeah.
And so short selling is very difficult. But for the average investor, it's probably time to just do what Buffett is doing, just hoard cash until there's a better opportunity.
Yeah. Well, I mean, you just gave a very good definition of FOMO, and that's what it is. Because people don't have patience. They're sitting at home. They're doing it for the first time. Their dumb neighbor just made some money on it, and then the other one, even though they're really smart people, I'm sure. But I mean, dumb means that you're like, and we've had a back and forth on this, just looking at dumb money versus smart money. There's indicators for that. So again, it doesn't mean that you're actually stupid. I mean, we know a lot of people on Wall Street that are. But I mean, it's that you're just not that on the edge of institutional money, or you're not on the edge of the information flow. That's what I mean. Uninformed would be another way to think about it. And lucky. It's just like being lucky at a gambling at a casino. I mean, it's not that complicated for people to understand. I actually got to ask this question, obviously, as well, and I don't know where you stand on this. Which of the reserve currencies will fall first and experience hyperinflation and needing a gold peg?
Oh, shit. I mean, some of these questions are just too difficult to answer.
Yeah,
I do think that I'm bearish on the dollar. I do think that there's a few different things I look at in terms of the dollar. One is the fundamentals, and to me the fundamentals, there's two fundamentals for the dollar. One is the fiscal situation. The dollar is highly correlated to the fiscal deficit. When we have a surplus, we have incredible dollar strength, but the last time we had that was 20 years ago. When deficits are expanding, it's bad for the dollar. And now deficits are expanding like they haven't done in 100 years. And so to me, that's a very bearish fundamental for the dollar. But also, you can look at things like purchasing power parity and the valuation of the dollar. And the dollar is expensive relative to almost every currency on the planet, euro, yen included, especially against the yuan, Chinese yuan. And so I do think the dollar is the one that's probably going to roll over first, especially if, as we talked about, the Fed decides they need to do more, pump more money into, quantitative easing, buying treasuries, buying, corporates, buying stocks. Then that's the outlet for that is going to be the dollar, is going to be the currency.
Well, on that, and slide 122, guys, so that you can, not everybody says it the way that Jesse just did, which is he's incorporating the relative value of the dollar against the trade-weighted basket. So the Chinese yuan is actually one of the major reasons why that thing's effectively at the in terms of at least Jesse in my career. I mean, that's at an all-time high. So it wouldn't be hard, as Schiller would remind you, to see a mean reversion from there. In my model, and again, I've been bullish on the dollar since mid-18. I'm probably a month to 2 months away from shorting it every day that it's up. So again, when you get out of quad 4 and into quad 3, we've already gone through this part of the discussion, Jesse. Quad 4 is what perpetuates dollar strength. People go to cash. But then once you get a debasement and it's a stagflation instead of a deflation, all my back tests say that the dollar is a short. In fact, the dollar is actually a short in every economic quadrant other than quad 4. So, that makes simple sense too. When the global economies in 2017, all their currencies are going up in dollars, and the dollar's an easy short. This one, it'll take a little bit more time, but again, I think you're right. I mean, if we go to MMT and we commit to devaluing the dollar, like explicitly, like buy stocks, it's going to be pretty easy to explain because we're not in Quad 4 anymore anyway.
Yeah, absolutely. And I would say we started MMT last year,
right,
when the Fed stepped in, to fix the repo markets. I felt like that was because Treasury bill issuance was already starting to take off because we had $1 trillion deficit and there wasn't enough, money in the system to soak up that Treasury bill issuance. And so the Fed had to step in and start monetizing the $1 trillion deficit late last year. So to me, that's when MMT started.
Yeah, that's. Do you think? I guess there's some other questions related to this actually. Do you think? And we're running out of time a little bit here, but do you think that MMT is going to have bipartisan support, into the election or coming out of the election?
Yeah, I think it already does have bipartisan support. I think already to see that we already put money in the hands of Americans and basically did that through debt issuance and told the Fed to buy it up. To me, that's that's MMT, and it was those bills passed Congress with bipartisan support. I'm not saying we shouldn't have done that, right? We have to do things to help the people who are hurt most by this.
Yep.
But the fact that it's both Democrats and Republicans now are talking about ways to spend money that's debt financed and there's no consequences so long as the Fed can buy it up, tells me that there's already bipartisan support for MMT.
Yeah, I had a great discussion with a major hedge fund manager that everybody would know. It wouldn't matter if you knew him or not. You can have a smart discussion with people who aren't major hedge fund managers. By the way, that's not exactly an accolade going back the last 10 years anyway, looking at some of these returns. But again, so we're debating like whether or not the money that you're giving to people that actually need it, i.e. they're on unemployment, they're one of the many people that need to feed their families. Like I'm totally hopefully Jesse and I don't get painted as people that that say screw that. But we're having a debate about, is that cash and a one-time thing to offset a need, or is that cash flow? And cash flow being something that you're going to give them past July, into August, keep rolling it, quarterly cash flow. There's a difference, and I thought we had a pretty. I mean, we were trying to walk through that, and I didn't come to tremendous conclusions other than the fact, well, it depends on what the government's going to do. I mean, what do you think?
Yeah, I think probably, we're going to find that the economy's reopening right now, and it's just not going to come back anywhere near full strength. And so I think a lot of these jobs that we are looking at as furloughs right now are going to be permanent job loss. I think that's the sad fact of it. And so I think that the Congress is going to have to come up with their fourth or fifth or sixth, whatever bailout package and extend these types of payments, extend the extra unemployment benefits, all this type of stuff to get us through this. And I think there will be bipartisan support for it.
Yeah, and that's again, that's an interesting world. I mean, people that will then say, Jesse, and maybe this is a good way to end the conversation. They'll say, well, don't I just buy stocks? It's like it's just...
Well, yeah, and I saw a statistic. I think it was 90% of people who they polled said they put that money into a trading account, into Robinhood. And you mentioned FOMO. For me, I come back to the quote from J.P. Morgan, which is nothing so undermines your financial judgment as the sight of your neighbor getting rich. And that's exactly what is going on right now, is that people are getting this free money from the government. They're seeing people make a ton of money in stocks. Wall Street bets on Reddit, all these guys turn in whatever it is, 10 grand into a couple $1 million through call options. And so this is a euphoric experience right now, unlike anything that I think we've seen in our lifetimes. So I think people, investors who are listening to this are probably not in that boat. They're probably being much more cautious already, if not, trying to trade from the bear side. But I validate those views completely.
Yeah, I mean, and what is it that, and maybe final point on this, like you've decided to commit, and again, it's a lot of time, it's a lot of care you put into what you write. Like you say, you're curating a great Twitter stream for people to learn from. Like, what is it about that, in this seat that you have today, Jesse, that you would have had, in the other seats you've had on Wall Street, at a hedge fund or at Bear Stearns, I believe. I mean, look, what is it about that? Is that something that makes you proud?
Absolutely. I mean, that's why I started blogging in 2005. Was the housing bubble felt like deja vu from the dot-com mania to me, and I wanted to try and put a different view out there. Bend, Oregon was the number 1 or 2 most overvalued real estate market in the country at the time where I live. And they were not getting any message other than real estate will only go up forever. It's never gone down. And I think that's the message that we get a lot from the mainstream media now too, is that the stock market, just put your money in, buy and hold forever, and you won't regret it. And that's just not true. There've been long periods of time, 20 years plus, where people have put money in the stock market and been, down. I think, you tell somebody in Japan to, buy and hold, and they laugh you out of the room. And I sadly think that, we're going to look back 20 years from now and see that this was a major bubble in the process of bursting, and this buy the dip mantra was one of the types of false beliefs that drives every bubble in the past, and it will be proven to be a false belief over the next few years.
Yeah, and I sincerely appreciate that, man, because standing cowardly idle and saying nothing, there will be many, and you're not going to be one of them. So thanks for making the time, and thanks for explaining your views, and I'm sure everybody's going to enjoy following you if they don't already. He's Jesse Felder. I'm Keith McCullough. You can find us both as soon as we get off this conversation. In fact, we'll both be on Twitter, and he's also got the Felder Report. I highly encourage you to check that out. Thanks for making the time.